If I stay with the first question first, I mean, there were many stories around that include sort of some idea of how you essentially sort of do not increase the quantity of money or reserves whilst you're at the same time buying bonds. There was an earlier story that suggested that in order to offset that, the ECB could sell some of their core holdings, bonds, OATs, something like that. There's this draining that you're referring to. We had something like this in the past when the ECB, at the very first instance, bought bonds in the time what they called their security markets program, where they were sterilizing, as they called it, the liquidity that they created. And it really goes to the heart of what you were just saying, that on the one hand, the ECB wants to support or needs to support the Southern Europeans, where the spread is a major element, whilst on the other hand, they obviously want to raise interest rates as a whole, and creating liquidity is obviously an easing tool, so they have to somehow square that circle. So can it work to some degree? I guess it can, at least optically. They can mitigate the liquidity creation that would come with a bond buying program. But the clear thing really is, does the tool have success in reducing the spreads, and then do they lift interest rates? And that leads me to the other question that you asked: is it clear that the ECB wants to go towards the levels that are currently implied in markets? I mean, I think the very first target that they have in mind is some fuzzy level of neutral interest rates. Holzman, one of the archhawks from the ECB, was out at one point, and he was suggesting 1.5. So I think that's probably an area where the ECB wants to get to.
Just in the round, as we're looking at the economic data that's coming in, it's not confirming that we are headed into recession at this stage. The data out of the States overnight was very curious. If I look at my notes on this, if I can find my notes on this, the durable goods order was better than expected. The pending home sales came in better than expected, in fact surprising with its strength to the upside. And yet, as you look at the way the market's repositioning, it is anticipating recessionary conditions. What's going on here? Is there one part of the market that's assuming that the Fed will actually cease lifting interest rates because of the weakness we're seeing in other places? Or is the data just suggesting maybe that we're not having a recession and that some parts of the market have got this wrong?
I think in terms of data, what we currently have, if I may, is a lot of the forward-looking indicators and a lot of the survey data, such as the PMIs, for instance, or in some cases new orders, they are decelerating relatively sharply. I mean, if you look, for instance, at the European PMIs that came out last week, they were below expectations, particularly in the forward-looking part of the indicator. And even though they're still sort of in expansionary territory, we are approaching the crucial dividing line. The actual data that comes out in the here and now, that's typically tends to be still on the strong side, because it obviously takes a while until some of the interest rate increases feed through into real economic data in the here and now. Now, as far as the market is concerned, you have to keep in mind that the way we had priced central bank action in the US, in Europe, and other places was relatively aggressive. And I was mentioning earlier that probably one of the ideas is to get back to a neutral level of interest rates. And even though it's unclear where exactly that is, the levels that we had, around about 4% in the US, 250 in the euro area, for instance, and those were almost certainly above most expectations of neutral. And I think the market is paring back that to some degree.